Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Good morning, Ben.
Good morning, Will. How are you?
Doing
You're
pretty
on
well.
destination today.
Yeah, another destination today. Let's see, a few weeks ago was Montana, then is a camper in Ohio, and now we're out in Palm Springs, California. So we're doing a lot of traveling out here for Ag Media Summit. It's been the first time in 4 years, I think, I've been to AMS, so it's really good to get out here. So uh,
Awesome. Sweet.
I heard you
You
had an
can tell, but
opportunity.
it's raining here.
Yeah, looking all cloudy. I don't know. It's been in the 90s to the mid upper 100s. So when I flew in Sunday evening, it was like 105 or something, and that was at 9 p.m. So it's a little crazy, but you know, but no,
Perfect.
some needed rain out there in the Midwest. So well, Ben, before we really jump into today's discussions, want to give a update on the prices that we're seeing. September corn for the 23 year down 44 cents in the week at $5.04. December 23 corn down 43 cents at 5.13. September 23 soybeans down 83 cents at 13.70. November 23 soybeans down 75 cents at 13.31. Soybean oil for September down 5.1 cents at 63.11. Soybean meal by the short ton for September down $6.60 at $423.80. That 23 September wheat crop is down 80 cents at 665. July wheat for 24 down 73 cents at 691. And then you see that crude oil for September up $3.51 a barrel at 81.88. So Ben, a lot of soft to moderate losses there except for crude oil.
Yeah, that's right. Actually, a pretty, I guess maybe a downward tent to the week. We saw, a couple of big things really break that created this bearish tent to commodity markets. One, Chinese data continues to remain very soft. In fact, overnight this weekend and even last night, some even more bearish news coming out of China. Improving outlook maybe for crop conditions the rest of the month for corn and soybean production here in the United States. And then, just a recognition again that demand has been rather soft. And so all those factors, I think, have kind of caused, traders to kind of sit to the sidelines, and that's allowed markets to move lower. So yeah, that's what's led to almost, 80 cents plus of a decrease in soybeans on the week.
Well, Ben, you talked about that softening in demand. We did see a little bit of a bright spot maybe on the corn demand side from an ethanol standpoint with production having a 28-month high. Where do you see that moving forward from? Is this a good sign for the ethanol market moving forward?
So I had a mentor, and he was one of my greatest advisors, Dr. Barry Flunchbaugh at Kansas State University. He was the ag policy specialist there for a long time, known countrywide. He was famous for talking about the three-legged tax school, or stool, not school, sorry, three-legged tax stool of income tax, property tax, and sales tax, and how they needed to be in balance. And I've always kind of laughed at that because in my world, I talk about the three-legged corn demand stool of ethanol exports and feed use. And for what seems like has been a long time, many months here, we're finally seeing some stronger demand in one of those legs of the stool here on the corn ethanol side. Coming in and producing 322 million gallons of ethanol on the week. That, as you mentioned, was the largest weekly volume in many months, all the way back to January of 2020. So pre-pandemic, kind of getting through that psychological barrier, getting back pre-pandemic a little bit. As where I see this going forward, it's nice to see this starting to rebound and kind of catch up here in our summer driving months. I do think that as we look ahead into 23, the rest of 23 and into 2024, corn ethanol production is going to, continue to see some rebound on cheaper costs, right? Lower corn prices year over year. That helps, with the profitability there. We're seeing ethanol prices remain, rather sticky, and that's creating, a slight margin for some of these ethanol plants. And so as I look for the rest of 23, maybe even to the start of 2024, some solid corn use for ethanol numbers.
Well, just talking about that three-legged stool, another leg that you mentioned, the export market, it's still really seems to be unimpressive, maybe within expectations, but not really blowing anybody away. What's the future, I guess, for all of the main commodities when you look at the export side of things?
Yeah, great question. So I would say that for corn export sales, it's we've got just a month left in the marketing year, and export sales have been pretty disappointing up until this point. We had probably what would be considered a neutral report last week for many of our commodities. I say neutral from the standpoint that it was better than what we've been seeing, but it just didn't break that psychological barrier there that we were seeing strong volumes. On the export inspections front, we did see what I would consider to be a rather strong week, relatively speaking. There, wheat, one of those feed grains that we kind of grouped together with grain, sorghum, and corn. Wheat saw a very strong week, above all pre-report expectations. However, when you sit back and think of where we should be at this time of the year for all those commodities, it was pretty much just treading water, right? Like, this is where we should be this time of the year. So, a celebration if you're a bullish corn, if you're bullish corn, if you're a producer trying to sell corn, a celebration that we're seeing some demand pick up in the export market, but a tampering and kind of a sombering realization that, hey, this is just where we should be. This isn't exceeding, or blowing things out of the water by any stretch of the mind. So.
Well, and just with that 1 month left within the marketing year, what kind of push do you think could be in the cards for the next month or so, or do you expect more of the same old of what we've been seeing for most of this session?
Yeah, same old, same old. There's large supplies down in South America. Our crop here in the United States, we've talked about the supply picture extensively. I do think that there is, a corn crop out there that maintains our ending stocks position. That's not subtracting it. That's not growing it. Just kind of maintains it. And that is, actually kind of impressive given how much this crop has faced in terms of dry weather and lack of rainfall.
Yeah, so really, I guess barring anything drastic, you're not going to see a big shift within trade expectations or the functionality there. Ben, something that we are looking at that had a recent shift in it, the Federal Reserve continued to raise interest rates by 1/4 point this past Wednesday. How do you expect this to be impacting ag markets moving forward?
Yeah, so this was the 11th rate hike in the past 12 meetings. Takes us back to the highest rate all the way since the early 2000s now. The Fed surprised traders in June when they didn't make an adjustment to their target rate, but they came out and gave a very definitive statement that there would be 2 more rate hikes yet in 2023. We got one of those here in July, another 1/4 point interest rate, and they were back to their traditional language of future rate hikes or future changes in the rates will be justified by data, right? Like, they will monitor economic conditions and watch for any indication that rates needed to be changed, right? So that's their traditional language. So you still have this kind of elephant in the room, if you want to use that term, of they said there'd be 2 more interest rate hikes this year. We got one. Is there going to be another one in November? And I do think there will be another 1/4 point interest rate hike in November. And then the Fed's going to hold those interest rates for a long period of time. So what does this mean for agriculture? One, lending has gotten more expensive, or borrowing money has gotten more expensive, and we're going to see interest rates impact farm income, and we're going to certainly see that start to trickle into some of the fixed assets like land values and equipment and other stuff like that. So I certainly expect that in the next couple of years, we're going to be talking more and more about the pinch that interest rates are having on agriculture. I'll just simply say that I think the economy is rather strong. And I use that word to say I'm not convinced that we're going to see the interest rate cuts that many market observers are anticipating next year. Okay, I think the labor market has proven to be resilient. We've seen a cooling of the economy without massive amounts of people being laid off, and our unemployment rate is still below 3.8%. It's down to like 3.6, and so I see that as an indication that this is a long term, the Fed's going to hold for a long period of time, maybe multiple years here, at these higher interest rates, and producers are going to be burdened with that in the face of lower commodity prices. And that's the challenge for us as we look 1 to 2 years down the road, is interest becoming a bigger expense than what we've become used to over the last decade.
Well, and that's just it. I think of, people, Ben, like you're my age, and we see these interest rate hikes, and this seems very, very high and very strange and very abnormal. But, I feel like there's a bit of a different perspective out there that a lot of farmers might be able to have, because this might not be, the worst interest rates that they've ever seen in their lives. So as you see how farmers might operate over these next couple of years, if these interest rates do hang around, how do you expect maybe your average crop production operation to adjust accordingly? What do you expect to see at a micro level from a single business standpoint?
Yeah, so it's going to cut into profit margins in a variety of different ways. All the way even to carrying grain, right? That opportunity cost loss of carrying grain has an interest component. So, there's a lot of ways that interest rates are going to affect profitability and cut into operations. But I guess the biggest takeaway here is, for farms that are well established, interest rate changes don't really have a huge impact in their finances, or at least their per unit production cost. But it has a pretty large impact, and I say pretty large, that's a relative term, right? But a pretty large impact in rather new farmers, farmers that are trying to get established over the next couple of years. So not even those that have came in the last 5 years, but those that are trying to return back to an operation or return to a rural community now. Those are the ones, as they're trying to find a line item to buy equipment to do custom harvesting. Those are the ones that are probably going to be hit the most by these interest rate hikes.
So, Ben, winding down here this week, I want to talk a little bit about the U.S. crop conditions kind of dropping a little bit more than traders might have expected this week. So what are your expectations on how that's going to move forward within the market? A lot of that's already been priced in to the market, but how closely are traders watching these conditions week to week?
Yeah, so I kind of teased this a little bit earlier. The mentality is that the crop conditions, even though they dropped this week, they're going to get better as we move through August. The irony of this is that's the same mentality we had in July, and then everything just kind of remained kind of a week ahead. So the mentality, or at least the sentiment, is that crop conditions are going to improve, that we're going to have rainfall here in August that's going to really help with that kernel size, right, as soybeans in some cases are setting pods. And that's where we're kind of looking at. I will note that as we look through the rest of this week here, this first week of August, there's a lot of private companies that are releasing their first consumer, or their first customer surveys. I think there's 3 I can think of off the top of my head that are set to release customer-based yield surveys today. And if those start coming in lower than anticipated, expect a big change in market sentiment that the crop's not there, right? So we're going to learn a lot in the next couple of days about the size of this crop. But I'm just warning you, it could go either way, right? Like, we're at the point where they could get in the field and those responses start coming back, and it's actually higher than what we're currently thinking. It drives the market lower. So it's a weird year, and some of this is going to be based on sampling, where the sample sizes and who's responding to surveys. So,
all right, Ben. Well, winding down this week's episode, what should farmers and ranchers really be paying attention to for the rest of this week?
Yeah, so a couple of just first of the month reports coming out this week. Grain crushings report and fats and oils later here on Tuesday. And then as we look to the end of the week, not really a big market moving report, but just kind of one that is very interesting to us, is that on Friday, August 4th, we do get USDA's land values and cash rents for the year. So kind of really just a data point in time, not really a forecast or not anything that really moves markets, but a good market for farmers to have. So.
All right. Well, it's always a pleasure to get your knowledge here on the program. Viewers and listeners, if you'd like to learn more about what we do or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.